this is Ibrahim from the Real Estate Group. In today's video, we're going to go over how you can buy a property for as little as $20,000. Now, with rising house prices, many people actually believe that buying a home is out of their financial reach. What if I told you there is a method for buying a property for as little as $20,000 or even less? If you've always wanted to own a home but you don't have money saved up for a 20% down payment, you'll want to watch this video because I will be discussing how you can buy a property with less than 20% down, and we'll be going over the pros and cons of doing so. So let's get started. Traditionally, most lenders and banks only accepted a 20% down payment for mortgages as a method to manage their risk. Now, with a traditional mortgage, if you wanted to purchase a $400,000 property, for example, you'd be required to make a 20% down payment of $80,000. That's a lot of money, and the reality is if your down payment is less than 20% of the purchase price of the home you want to buy, a regular or a traditional mortgage is most likely out of your reach. So now, do you wait and save more until you have 20% down? But what if prices increase further while you save? These are many questions that are constantly being asked by many people interested in purchasing. And that is where high ratio mortgages come in the picture. So what's a high ratio mortgage? A high ratio mortgage lets you borrow up to 95% of the purchase price, but you have to buy mortgage insurance from the Canada Mortgage and Housing Corporation, often referred to as the CMHC. The CMHC will cover the higher risk of this loan. Essentially, they'll be insuring this loan. Now, you have the option of paying for your insurance in a single lump sum when you buy your home, or you can add it to your mortgage and include it in your monthly payments. If you choose to pay the insurance monthly, you will pay interest on it. So let's use our example of a $400,000 property. If you go with a high ratio mortgage, the minimum amount you would need to purchase a property would be, you guessed it, $20,000. Now, your mortgage insurance premium on a $400,000 property would be around $15,200 to be exact. You could choose to pay this $15,000 upfront, or you could spread it out over your mortgage and add it to your monthly payments. As of February 15, 2016, new down payment rules were introduced for home buyers. Previously, home buyers could have a down payment minimum of 5% for any homes under $1 million. The new rules require a minimum of 10% down for homes over $500,000, but only on the portion of the price of the home which is over $500,000. So let's give you an example of this. Let's say the purchase price of a home was $700,000. You'd need to come up with 5% on the first $500,000, which is $25,000, and then you would need to come up with 10% for the remaining $200,000, which is $20,000. So the total down payment you would need for a $700,000 property would be $45,000. Now, just so you know, any home purchases under $500,000 are not affected by this rule. You can purchase a property under $500,000 for 5% down, which is the minimum. So now that you know what a high ratio mortgage is, you may be asking, should I wait and save 20% before I buy a property, or should I buy a property now with less than 20% down? Well, let's go over each approach and see what their pros and cons are. If you waited to buy with 20% down, you would pay less interest overall, and you would have a lower mortgage payment because mortgage insurance isn't mandatory. You would also have a lower risk of owning the home when you buy with 20% down. Let me give you an example of this. If you have to sell quickly because of some situation that comes up in your life, you could actually do so, and you can walk away with cash after closing because you have enough equity in the property built up, especially because you've made such a large down payment. Now, if you go with this approach, you will have to continue renting a property while you wait to buy. And you may end up having to save even more, especially if house prices rise in your neighborhood. And while you're waiting, you don't get to benefit from your home appreciating in value, and you don't build any equity in your property. Well, what if you bought now and with less than 20%? If you went with this approach, you would get to become a homeowner, which is a benefit. And you would also benefit from your home appreciating in value, especially if you're in a fast rising market. This is a really important point, so let me give you an example of this. Let's say you're in a market where property values increase by 10% every year. If you put 5% down, you'll have 15% equity 1 year later. 2 years later, you'll have 25% equity, and so on. One other benefit is you don't have to dedicate all of your capital towards one investment. you could use the rest of your cash on whatever else you please. If you do go with this approach though, keep in mind that you pay more interest and you will have a higher mortgage payment as a result. You will also have to purchase mortgage insurance, like I mentioned, and this is non-refundable even if you sell the property. And finally, you risk taking on more debt than you can handle if you buy with less than 20% down. Ultimately, the choice is yours to make. There's nothing wrong with making a minimum down payment on a house, especially depending on your situation. Sometimes it does make sense to put less than 20% down on a house, and it allows many families to have a roof over their heads that they can call their own. If you want to know what the best option for you would be, please feel free to reach out to the Abuat Real Estate Group. We can help you figure out what your monthly mortgage payments would be, and we offer many services such as mortgage approval assistance and specialized advice and insight into the home buying process. Thank you so much for watching. I hope you enjoyed this video. See you again next time.